Welcome back, you legends. I'm Dr. Kat. Let's get right into this weekly update video. The stock market fell 1.7% on the S&P 500 last Friday, 1.8% on the NASDAQ, and 1.62% on the Dow. Let's take a look at the different sectors, guys. The worst by far was energy, losing 7% in a single day, followed by basic materials, consumer cyclicals, and defensives. That's very unusual to say the least, but this is very typical, guys, of late stage collapse behavior. When we see commodities crashing and when we start to see the sectors that performed the best year to date, right? The best year to date was energy. When we start to see those sectors becoming the worst performers, this is very typical of the end stage, late stage collapse of bear markets. We are right now in the end stage collapse phase, which is the worst, most dangerous, and most severe phase. Let's take a look at the stock market map. Look at this, guys. Bright red on energy. We also have consumer cyclicals like Amazon and Tesla taking massive hits. Big cap tech, including Google, Meta, Microsoft, and Apple, all in the red as well. We're seeing some really small pockets of green, including dollar stores, discount stores, as well as defensive healthcare companies. Now, guys, I did warn about this collapse coming. In fact, just before I got COVID and got hospitalized, the last video I published before that happened was this stock market crash will take out the June low. This rare signal always preceded huge crashes. Everything really unfolded exactly as we expected. I'll go through this signal again today, guys, to show you how I spotted this. I didn't see anybody talking about this signal really, and it only flashed 3 times in the last 22 years, and every single time the results were horrific. This was the first time it flashed. It was back in late 2018, and just look at this, guys. We rejected off the 125-day moving average, and we sold off 15% in 14 trading days, 21 calendar days. The signal I'm talking about, guys, is when the stock market sells off below the 125-day moving average, attempts to retest, and gets rejected. This has only happened 3 times in the last 20 years, and they were all horrific. So this was the 2018 example. We lost 15% in 14 trading days, 21 calendar days. Very sharp crash, very quick crash. The prior time this happened was back here, guys, in the middle of 2010, and we had just as severe of a sell-off. We lost more than 10% in 9 trading days. The prior time this happened was right here, guys, back in 2001. Where we had this rejection of the 125-day moving average, and that sharp rejection led to one of the worst sell-offs in history, losing 22% in 32 trading days. Absolutely horrific sell-off. And so the best case scenario, guys, was 10%. The worst case scenario was 22%. The median was 15%. And in fact, I talked exactly about these percentages back here, guys, on September the 13th, after we got rejected off the 125-day moving average. We were waiting very patiently for this rejection. We did get this rejection. We were short. We got short right here. I added to my shorts again here in the form of a put spread, and I closed those shorts, took profits on those shorts right here, guys. So again, guys, if you're interested in following my trades, I do post every single trade and investment in real time in the trading community. It's $20 a month, and it's the best way to support me if you want to do that, and the best way to track all of my trading activity in real time. This is what the trading community looks like, guys. We do have a welcome page to show you how to sign up if you're interested, and I do share a lot of resources and research on the market. This, for example, was one research data point that I did share last Friday, and it talked about the price targets after rejecting off the 125-day moving average. I also share my watch list, my investment ideas, trade ideas, as well as my trades in real time. Every single exit and entry that I make to my portfolio, either my investment portfolio or my trading account, I do share those trades and investments in real time. We also have a lot of other rooms, guys, where our community discusses different news events, trading strategies, trade ideas, economic data points. I also have a Q&A section where I answer everybody's questions. No matter what your question is, it will get answered. So this is what the trading community looks like. Again, guys, if you're interested, the link will be in the description to sign up. It's 20 bucks a month. And again, it's the best way to support me if you want to do that. Now, going back to the daily chart, guys, again, I did enter a short position at 400 and again added to my short position at 406. And I rode that short position all the way down here for a 90% profit. I took profit here. And by the way, guys, it was a very low risk position. I positioned myself using put spreads, and I structured my trades to maximize profit chance, not profit potential, but profit chance, because the more successful trades you have, the better chance you have at growing your portfolio. And so it's all about minimizing risk using instruments like options and like spreads. Now, guys, I'm starting to see something very interesting. I'm starting to see a descending wedge, a falling wedge pattern. We had a very similar falling wedge pattern back here, guys, on September the 6th. And we did end up with a small counter trend rally, right? I'm starting to see a very similar structure, but I'm not seeing as many bullish developments as I did back here. For example, guys, our trusty HYG, the high yield bonds, I'm not seeing a bullish divergence just yet. In fact, I'm seeing a bearish divergence where the HYG has actually made a new low. And for everybody who's been following this channel, you will know that the HYG divergence is one of my favorite entry and exit signals and swing trading strategies. I'm not seeing a divergence just yet, but I'm seeing some very, very small divergences in the 15-minute chart. Let's take a look at the 15-minute chart and look at this, guys. We do have a double bottom formation, right, with a lower low on the 15-minute chart and a very slightly higher low on the PPO. We are in a bullish context on the 15-minute chart, and we do have this gap coming in at $374. We could see that gap getting filled next week, maybe slightly overshoot that gap and begin to sell off again. So in the medium term, guys, I'm still very bearish. In the very short term, I'm anticipating a potential counter trend rally, right? We are now breaking out of this descending wedge. This was the first time we closed above this resistance line on the 15-minute chart. So I am beginning to see some very small, minute bullish developments, but not enough to go full bore bullish. We filled this gap here, guys, on the daily chart at $366. We filled that gap, and then we had a small rally towards the end of the day on Friday. Now, again, guys, if you've been following this channel, you will know that I've been watching this gap at 378. We filled that gap right on the dot, and this gap at 365. Again, we filled this gap right on the dot. And so we're hitting every single target that we've been waiting for. And now, guys, I do have another downside target, and it's right here, $340 by about the mid-October time frame. And there are multiple reasons why I'm looking at $340. Number one, guys, we do have the 50% Fibonacci retracement level from the pandemic lows right here. This is the 50% retracement level at $350. Below that, at $320, we have the 62% retracement level. And so, guys, this area is going to be an extremely important area of interest, where I suspect there's going to be an epic war between the bulls and the bears. The bottom of this range is going to be 320. I do think 320 is in play. I do think it's possible. I'm not sure if it's probable, but it is possible. 350 is very likely, as well as 340. Again, 350 is the 50% retracement level. It's also the level at which we will retest the 200 weekly moving average, this dark blue line. And the $340 level is important for two reasons. Number one, guys, do you see this red line? This red line, this red demarcation line, guys, splits the price action on the S&P into bullishness above it and bearishness below it. And the reason this works this way, guys, is that for the majority of this bear market, we were trading below this resistance line. As soon as we broke above it, we had this retest and a rally. And so this was the most significant rally that we've seen in this bear market. And on top of that, guys, if we go back all the way down to 340, by mid-October, we will be retesting this prior resistance line, now a support line. And even if we retest it, guys, on the weekly chart, let's take a look at the weekly chart, we would still be in a bullish context on the PPO because we will have made a higher low on the PPO and a lower low on the S&P 500. So $340 is my number one level that I'm looking at. 320 is very possible, but if you're a long-term investor, you might want to think about putting forward an accumulation strategy at $340. In addition to that, guys, let's take a look at the SPX. I want to show you something very interesting here, guys. Now, this is the S&P 500 index, not the ETF, the index. And what do you notice, guys? This is the volume shelf profile. And just look at this absolutely enormous air pocket. And the air pocket ends at $340 on the SPY, $3,400 on the SPX. So it makes a lot of sense. We do have a lot of volume here, guys. So I do expect a lot of buying here between 3,400 and 3,200. 3,200 again is the 62% retracement level. 3,500 is the 50% retracement level. And both of these levels are critical because they sandwich this absolutely a critical consolidation zone, right? Where it tops at 3,500 and bottoms at 3,200, and 3,400 is smack down the middle. So 3,400, guys, is a very logical level to me, as well as 3,200. I think 3,500 will be taken out. I think we'll go below that simply because we have this massive air pocket, and because I expect a retest of this prior resistance line, now a support line. One very likely scenario, guys, is that towards the end, perhaps towards the end of October, we'll see something that looks like this, a false break bottom, right? Where we break below this prior resistance line, now a support line, and we create a false break bottom. And then towards the beginning of November, remember, guys, November is a very bullish month, as well as December in terms of midterm year seasonality. From a seasonality perspective, guys, November and December are very bullish months. Look at this. Every single midterm election year, we had a beautiful rally towards the end of October, early November, as well as in the entirety of December. So I am bullish for November and December, but before then, I think we go to at least 3,400 and potentially, very possibly, 3,200 to make that false break bottom. And as well, guys, if we draw a parallel line to this descending channel that touches the prior false break, right? This was a false break bottom that we had in June. We broke down out of this descending channel, and then we rallied. And so if we do the same thing again, and if we create another false break bottom, just look at this, $325 towards the end of October. So it makes a lot of sense. We have the 62% Fibonacci retracement level. We have this parallel channel, and we have this false break bottom concept. So these are the levels that I am watching, guys, for the many reasons that I outlined, including weak seasonality towards the end of October, including the Fibonacci retracement level, including this support line, including this descending channel, and this false break bottom. And on top of that, guys, please stick around to the end of the video. I'm going to discuss the stock market valuations. So even if you're not into technical analysis, stock market valuation is the #1 indicator to look at if you're a long-term investor. If you're a Warren Buffett-like value investor, you want to look at the price to earnings ratio in comparison to the historical average, as well as in comparison to the yields. And so please stick around to the end of the video, because 3,200 will make even more sense when we look at stock market valuations. Now let's take a look at the triple Qs, guys. Again, the triple Qs are forming this descending wedge. We do have this support line that I'm tracking. We're now tagging it again. And I suspect, guys, we'll see a small counter trend rally, perhaps filling this gap. As this 9-day EMA descends, we could see another day of rallying that tags this 9-day EMA, at which point I think more bears will pile into this trade to push the price back down. In terms of the price target on the triple Qs, guys, I'm actually looking at two critical price targets. Number one is $255. And again, this is the the 38% Fibonacci retracement level from the bottom of the pandemic lows to the 2021 top. So the 38% retracement level is sitting at $255 on the triple Qs, and below that, I'm actually, guys, looking at this level, the pre-pandemic highs at $237. This is going to be a critical level for many reasons. Number one, just look at this enormous ascending wedge channel. Look at this, guys. We systematically tagged it back here, 2016, again, 2019, again, 2020. We've respected this channel perfectly. This ascending pitch fan channel. I've hand drawn this channel. And again, guys, if you're interested in following my charts, I do share all of my charts in the trading community. Now, if we track this support line, guys, look at this. It's going to hit the pre-pandemic highs right in the middle of October, perhaps towards the end of October. So again, as the S&P 500 hits 3,200, I expect the triple Qs to hit $235 to $240 to retest the pre-pandemic highs. This, guys, means let's take a look, a 14% sell-off from the current levels. And on the S&P 500, everybody, 3,200 would be a 12% sell-off. So in fact, the triple Qs might even undercut that and go to the very bottom edge of this ascending pitch fan to $230 by late October. Now, looking at this chart, this does look kind of insane, doesn't it? I mean, a sell-off all the way down to $235. That's just an insane sell-off, isn't it? But it's within reach. It's absolutely within reach, especially as yields continue to rise. The triple Qs will continue to get hammered and underperform the S&P 500. Now let's take a look at the VIX, and again, like clockwork, look at this, guys. We tagged this resistance line. The prior times, guys, where we tagged this resistance line, after the initial tag, boom, we had actually a small relief rally, boom, another small relief rally, boom, another small relief rally, and again, boom, small relief rally, again, small relief rally, and again, a small relief rally. So I am expecting a very small counter trend, small relief rally in the stock market, in the S&P, as well as the triple Qs, especially, guys, as the dollar begins to perhaps slow down a little bit, because we're now getting very close to the upper edge of this ascending channel. So I do suspect that the dollar will probably doodle around at the top range of this channel for a few days, perhaps even a few weeks. And if the dollar cools down, and if the VIX cools down, and I do suspect that the VIX will want to cool down just for a few days at least, we might see a small counter trend rally, at which case, if you're a bear, that will make for a nice entry to continue to short the market to the downside if you want to do that. Now let's take a look at the IWM divided by the S&P. This is the Russell 2000 divided by the S&P. And this is a risk on, risk off barometer, guys. And I talked a lot about this ratio chart because I was waiting for a close above the 50-week moving average. Because, guys, the last time we closed above it, we had this massive rally in the stock market. So I was waiting for a close above it, but we haven't gotten that close. In fact, we've gotten a rejection. We rejected and we sold back down to the 20-week moving average. Now we formed this very obvious bear pennant. This is a bear pennant, guys, and it looks to me like it wants to break to the downside. So watch for a break, a close below this support line here. If we close below that, guys, expect a lot more weakness in the small caps, in high risk stocks, in high growth names, in the ARK-K fund type of names. Back to the HYG, guys, I do want to point out something very interesting. I did talk about this. Remember, guys, the 5 phases of the HYG cycle. I talked a lot about this as we were rallying back in August. As everybody has been saying, oh, the stock market has bottomed. We're rallying. Rah, 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 rah. Go full in, buy everything. The Fed is going to pivot and so on and so forth. And I was warning that, oh no, the HYG has this very distinct 5 phases that it goes through. The first phase, guys, is a small rally, then a sell-off, another rally, period of consolidation, one last rally, and then a massive, massive, massive period of selling. We had that exact same thing happen, guys. We had that cycle reset in May. We had this rally, this massive sell-off. This was the capitulation, between air quotes, capitulation bottom. Now we know it's probably not the bottom at all, and we have a lot more risk to the downside. And then we had this brief rally, period of consolidation, one more rally. This rally lasted longer than a lot of people expected, including me. And it was actually fueled by this, guys. On the 27th of July, we had an inflation reading that was bullish. It was below expectations, and it fueled a continuation to the rally. And then the Fed came out and said, oh no, what are you guys doing? Are you insane? We're tightening. We're not pivoting. Inflation is so hot. We're going to continue to raise rates. What are you guys doing? And suddenly the market remembered, oh no, the Fed is still tightening. We're still in a tightening cycle. And we had this really tremendous sell-off, absolute insane sell-off. I mean, from the top, guys, of that bear market rally in August till now, we had a 15% sell-off, and down to the $320 target, that would be a 25% sell-off to 3,400, which is a very likely target. That's 20%. And so if you got in here as the market was rallying and you did not get out at the top, as we were warning, as we spotted that divergence in the HYG and the S&P, you will have lost a lot of money. Unfortunately, guys, such is the nature of the beast, such is the nature of bear markets. Now, guys, this cycle, I actually drew this cycle all the way back in July, and I did put it ending at the end of September, and that's because of seasonality, because towards the end of September, we tend to see some small counter trend rallies that extend into the middle of October. And so guys, I think we might see some counter trend attempts towards the beginning of October and the middle of October, and then one last dump, and then forming that bottom towards the end of October, and then to start seeing that beautiful holiday November, December rally. Now, this all assumes that the economy does not go down the drain in the interim. Now, guys, as the dollar index has been rallying, gold has been continuing to sell off. I did talk a lot about gold here. I was waiting for this bullish crossover to occur before I accumulated or started to accumulate gold. We never got that bullish crossover, and thank God I did not front run the signal, because just look at that. We're now continuing to sell off, and we will probably continue to sell off all the way down to $150, possibly even down to $148 on GLD. Now, again, guys, I will continue to wait for that bullish crossover. I do believe that we will get that bullish crossover as smart money begins to exit out of the dollar and run into gold as the next safety play. When that's going to happen, the timing is going to be very tricky, but thankfully, we do have the technicals, and I'll be waiting for that bullish crossover. And if we get that bullish crossover with a higher low on the PPO, as gold makes a new low, that will be a beautiful bullish divergence signal to go long on gold. Now, let's take a look at our buddy Apple, one of my least favorite stocks at the moment, simply because of the insane valuation on this company. And unfortunately, guys, the chart looks pretty bad. It looks pretty bad. We haven't gotten a bullish crossover. We're now sitting at that critical $150 level. We will probably see one last attempted rally in Apple, as well as the rest of the stock market, get rejected right here at around 153.5, perhaps even 155 right here, get rejected, and for the next leg of selling. And the next leg of selling, guys, I expect the next leg of selling to actually take us down. Let's see. Boom, all the way down to take out the June lows by late October. I absolutely believe that. I think we will go all the way down to retest this demarcation line. Again, guys, this is a bull bear demarcation line. Above it, the market is bullish. Below it, the market is bearish. And even if we retest it towards the end of October, that would still create a bullish divergence between the price action and the momentum, and that will make for a nice entry to take advantage of that November-December holiday rally. Let's take a look at Microsoft. Microsoft, again, one of those big cap tech companies that took out its prior low, the June lows. In fact, guys, I think Microsoft will sell off all the way down to about $220, right smack in the middle of this messy consolidation zone, right around $216, $217 to the bottom edge of this descending channel. And again, guys, if we take a look at the full measured move, we will get a full measured move that takes us down to at least $225 to the very top edge of this consolidation zone. I think we'll probably see even more selling deep into this consolidation zone. Let's take a look at Google. Google looks just as bearish. We took out the June lows, the May lows, all of the lows, we took them out with Google. Again, a full measured move. Look at this. Boom. Will take us down to the bottom of this red box. And yet again, it comes in contact with another consolidation zone. So it's a zone that makes a lot of sense, and $90 for Google makes a lot of sense to me. Let's take a look at semiconductors. This is a ratio chart for the semiconductors divided by the triple Qs. Again, I'm waiting for a retest of this 200 weekly moving average and this support line. This is a daily chart of AMD, everybody. And again, look at that. We took out all of these prior lows. We are now trading within this air pocket. There's not a lot of trading in this area, guys. And so price movements are going to be very violent here because there's not a lot of trading volume here. And so I actually think AMD will go all the way down to the high 50s, low 60s to the bottom of this descending channel and the bottom of this very long-term channel. This channel, guys, goes all the way back to early 2016. I did adjust this channel as soon as I saw AMD break this July low. I redrew this channel to account for this very obvious air pocket. In fact, let's take a look at this air pocket. Here it is. Look at this absolutely enormous air pocket, guys. There's no trading volume at all here. And so I think AMD will, boom, go all the way down to the bottom of this air pocket, again, to the high 50s. At this level, guys, we'll be talking about AMD trading at the pre-pandemic highs. And the triple Qs will be trading at the pre-pandemic highs at these levels as well. And Google will also be trading at the pre-pandemic highs right here at the mid-80s. So it makes a lot of sense as we're seeing tech continuing to get hammered. Google, the triple Qs, all these tech companies will probably revisit the pre-pandemic highs. Now let's take a look at the 10-year yield. Just look at this absolute insane rip your face off rally in the 10-year yield. We never broke below the 9-day EMA. This is a very bullish uptrend in the 10-year yield. We might start to see a small retracement back down that will allow the stock market to have a small counter trend relief rally. I do suspect that will be coming possibly next week. Let's take a look at the 2-year yield. The 2-year yield is just ripping like I've never seen anything like this. Look at this, 4.2%, and it will continue to move up because, again, remember, guys, the Fed raised its projections for the terminal rate by next year to 4.6%. So the 2-year yield will continue to move up. And as long as it continues to move up, it will put a lot of pressure on multiple high growth names, especially in the tech sector. Now let's take a look at Brent Crude Oil. And again, guys, remember when I talked about this nasty bull trap rejection, this false break, really evil trap that we've seen the market put in. We had that break above the 50-day moving average. And then not only did we reverse immediately the next day, we closed below the open of the previous day. And as soon as I saw that, I got out of all of my longs in energy, and I never looked back because there's really nothing stopping this rollover in oil all the way down to the $65 range on Brent Crude Oil and the low 60s on WTI. This is the XLE, the S&P 500 Energy ETF, and just look at this insane sell-off. Just in a single day, we lost 7%. That's insane. And look at this massive volume. So this was a massive distribution day. We're now sitting at the bottom of this ascending channel. If we break this channel, remember guys, we've been trading within this channel going back to, let's see, November of 2020. We've never broken below this channel. And if we do see that, guys, that'll be game over for energy. Really, this looks like one massive double top formation, right? One massive ugly double top formation. And there's really nothing stopping the energy sector from selling all the way down to the prior highs in late 2021 at $60 for XLE. Now let's take a quick look at seasonality, guys. Towards the end of September, we do tend to see this one last leg of selling. We've probably seen that. And then we have this small counter trend rally, right? We don't always get this small counter trend rally, but I'm seeing some small hints that we might see a small counter trend rally. Then we get another leg of selling towards early October and one last bear market rally from early October to the middle of October. And then the last sell-off, the last flush down, the bottom forming towards the end of October. And then hopefully, the economy will not have collapsed and we will be set to go for a nice bear market rally towards the end of December before more pain comes our way next year. Let's take a look at some stats. This is from Sentiment Trader, the AAPL Bear Bull Survey. Bears are now sitting at 60% of survey respondents are bears as of last week. This is an extreme reading and it comes really near the bottom, not at the bottom, but near the bottom. And so again, guys, this lends credence to the thesis that we are in the end stage of this collapse, of the 2022 collapse, at least, this bear market sell-off. We're getting very close to the end stage. I suspect that October will again be very bearish, and for November, December to see some nice relief rallies. One other insane statistic, guys. Look at this. Retail trader buy to open put premiums. We're sitting at 18. Just look at that. It completely eclipses the near 6 reading of the 2008 crash. We're now at 3 times the amount of bearish puts being opened. $18 billion in puts bought just last week. Again, this could be, guys, a very minor contrarian indicator for a small counter trend rally, right? When everybody is super bearish, we might see some small counter trend rally, some short covering rally. That is possible. But overall, this just doesn't look good, right? I mean, how can you possibly think that this looks good? It's just absolute insanity. $18 billion of puts being opened by small traders. So extreme bearishness. Let's take a look at the fear and greed reading, everybody. We're sitting at extreme fear as the close of Friday. As expected, I was waiting for the fear and greed reading to go into the extreme fear reading. And I actually think we'll go even below that. I think we'll probably hit the 0 level fairly soon. Let's say in the next 4 to 5 weeks. In terms of market momentum, we had this massive sell-off, extreme sell-off, right? We fell off a cliff. And so again, do not be surprised to see some very small counter trend rallies here. Stock price strength falling off a cliff, stock price breadth falling off a cliff, put to call ratio. We're getting very close to putting in a new high, right? Again, a lot of bearish puts being opened over the last several weeks since we put that top in mid-August. Market volatility, not only are we above the 50-day moving average, but we're now sitting at 30. So 30 usually, guys, often 30 is when we start to see some buying come into stocks, right? Again, every single time we hit the this descending resistance line, we had some relief rally come in, and so we might start to see volatility possibly cool down just for a few days as we start to see some short covering, perhaps a short covering rally. Alternatively, guys, if we see the VIX actually close above this descending line, that will be an absolutely horrendous bearish signal, and unfortunately that will lead to a lot more volatility and so much more selling. I'll be watching this chart like a hawk, and if we see a close above this descending resistance line, that would make it the first time this year that has happened, and it will be a very bearish signal. Perhaps the capitulation bottom we're looking for will happen if something like this occurs. Safe haven demand, again, bonds are outperforming stocks. Junk bond demand falling off a cliff. The yield spread is widening. We're nearing a new high for the yield spread between the junk bonds and the safer investment grade bonds. Now we come to the most important part of this presentation, guys, the historical valuation of the stock market. We're still one full standard deviation above the historical average. In fact, if we simply revert back to the historical average, we'll see a 40% sell-off in the stock market. Now, I don't believe that we'll see a 40% sell-off in the stock market this year. Absolutely not. I'm more inclined to think that we'll probably revisit the pandemic lows in terms of the PE ratio, and that will make for another about 10 to 20% of selling from September 16th. So let's take a look at September 16th. This was September 16th. So let's see, guys, 10% from September 16th will take us down to, look at that, $340. Again, my price target, my initial price target. And let's take a look at, let's see if it goes back down to 20%. That will take us down to $310. More likely, in my opinion, we'll see it go down to $320. Let's take a look at the economic events coming up next week, everybody. We do have some Fed speakers coming out. Bostic, Mester, and Collins coming out on Monday. Tuesday, guys, we have durable goods orders as well as new home sales. New home sales will probably fall off a cliff, will continue to fall off a cliff. They've been falling off a cliff for weeks and weeks now. Durable goods orders, we'll see what happens here. I'm not sure what's going to happen with this number, but I suspect that it's going to be weaker than expected. Wednesday, we have Fed Bullard and Bostic speaking, FOMC members Bullard and Bostic. Thursday, we'll have the GDP revision. And Friday, guys, we'll have the personal spending and personal income statements, as well as more Fed speakers speaking, and the Michigan Consumer Sentiment Index. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow. Wow.